Okay. Good morning, everybody. My name is Bob Kramich, your host today with Leverage Point. Welcome back to the Leverage Point Value Selling and Value Pricing series. Welcome to our session today called Pricing with a Purpose, Strategies to Navigate Tariffs and Volatility. Today's session is presented by Revenue Management Labs, a boutique pricing consultancy that helps organizations drive profitable growth through strategic pricing. I'd like to introduce you to our guest speaker today, Avy Punwasee, Managing Partner at RML. Avy has worked with leading business-to-business companies across industries such as manufacturing, consumer goods, technology, business services, and healthcare to solve very complex pricing challenges, particularly around navigating tariffs, shifting customer expectations, and internal barriers to pricing improvement. During the session, you'll see practical case studies, strategic frameworks, and clear actions you can take to price with purpose in today's volatile economic environment. So let's please welcome Avy to the floor. And I ask that if you have any questions, please submit them during the webinar to the questions feature, and we'll look to answer all the questions near the end of the session. So thank you for attending. Avy, I'll turn it over to you.
Thank you, Bob, and appreciate Leverage Point having us here today to share this material. It's a very challenging environment, and looking forward to kind of going through. Our goal for the session today is, as we work through the materials, as you're looking at the environment, tariffs, the volatility, the supply chain disruptions that you're looking at, that you can take away something practical and actually go back to your organizations and start to think about things in a new way, or make decisions with a little bit of a different lens that can drive some incremental profitability. So I'll jump right into it. Up front, we're going to just give a little bit of background on pricing within organizations and why things get a little bit more challenging given the environment that we're sitting in, and some of the just key guidelines to keep in mind. And we're going to spend the majority of the session really focused on three main strategies that will really help organizations navigate tariffs and volatility through pricing. And we've got a lot of time for questions towards the end, about 15 minutes. But as Bob said, as we go through the material, if you have any questions or concerns, feel free to put them in that question section, and we can go ahead and address them right as we're on the topic, working our way through. So really quickly on Revenue Management Labs, I won't belabor this a long ways, but what I'd like to say is we have a fair amount of experience across industries, so the foundations, the thoughts, the frameworks that we're showing you today are widely applicable. Secondly, as you're looking at the tools that we're putting across, what we really want to focus on is thinking about how you get that from at a very granular level. We're talking about the SKU, customer service, contract level, and really getting down to granular recommendations that you can take with your team. So with that, we've got the tariffs and volatility. Where we want to start is really thinking about, what are those key aspects or those key levers within pricing that you can pull to drive improvements? Because often we get myopic in terms of thinking, the pricing lever is the key one, but there's really three levers that you want to think about. And the first one, of course, is revenues, price times volume. As we break that back, first one is price. Now, optimizing that price, thinking about the customer segments that we're serving, and the competitors that they are shopping. Are we properly priced positioned or not? Where do we have leverage? Where don't we have leverage? Especially with the shifting of consumer behavior that we're seeing now. Secondly, as we look at the investments we make to drive volume, this doesn't only have to be discounts. This can be thinking about when we're providing special bid pricing out there, when we're giving special terms to a customer, when we're devoting more resources to an account. Thinking about those investments, what kind of incrementality do they drive to the top line? And are there things that we can do to go ahead and rationalize that spend and still drive the same amount of top line? Or are there things that we can do to go ahead and structure that spend in better ways so we can drive more incremental top line? And then the last area, which often gets unappreciated, we term that as balancing mix. And this is looking at the product, the portfolio of products or services that you're selling and thinking about what can we do with our portfolio and how we present that portfolio to our customers to have them buy longer, buy larger transaction sizes with us, or buy for higher margin. Now, those are really the three areas that you want to think about pulling levers. And if you take nothing else from the session today, I want you to take this. As I know a lot of questions are being asked within your organization now, thinking about the headwinds that you're seeing, be it on cost inflation, supply chain disruptions, or tariffs, as you're making those decisions, you always want to make sure that you cover three key elements for data inputs or assessments that you're doing. And those three elements are, one, what's happening with the customer? What is the value that we're providing to them, and how are we positioned? Number two, what's happening in the market with competition out there? How are they adjusting? And third, which I find most companies are very good at now, especially all the tariff scenarios that are being run, what's going on from a financials perspective. So as we're working our way through the material, let's keep those three elements in our mind. Okay, so what makes pricing so tough? And this is even before we get into any of the volatility. Well, typically when we come into organizations, there's organizations are struggling with two things. One, they are lacking some specialized pricing expertise. Number two, they lack resources, people around it, systems around it, tools around it. The other thing that makes pricing very unique is it's not like marketing or sales. It's kind of a discipline where everyone has their own vote or thoughts around how it should be done. So sales, if we lowered the price, we could go ahead and sell much more. Marketing, all we need to do is go ahead and sell the value. Finance, this is simple. Let's just go ahead and increase our price and we'll make more money. And operations, looking at the back end, we have more capacity. Let's drop the price. We don't have capacity. Let's go ahead and increase the price. So we don't have enough resources on it. Plus, everyone thinks we should be doing it in a different way. What complicates things? Well, this is the environment that you're dealing with right now. We've got some of our conventional channels that are disappearing. We've got tariffs that are on again, off again, and that are accelerating. Our supply chains are pretty unstable, and we're changing the footprint of those supply chains. We've got competitors who are getting much more aggressive out there. And we're seeing a lot of categories or markets that are actually maturing or becoming more saturated. And as those markets become more saturated, of course, each of these other elements, competitors getting more aggressive, becomes much more intensive. So not only do we have those conventional challenges that we were talking about around pricing before, but the market and the volatility that we're seeing, it's getting more aggressive. So how should we think about this? We've got kind of this perfect storm that's coming at us. First thing, we'd like to talk about tariffs. We know they're here. What's our position on tariffs, and what are some guiding principles that organizations should have in mind as they're dealing with it? One, tariffs are sticky. Once they get in place, they stay in place for a long time. Now, what should you take away from that is two things. One, don't necessarily wait to do anything as your company's impacted and see how things kind of iron themselves out, because it's going to take a while for them to wind their way down. So it's going to have a cost impact on you. Think about how you build those tariffs, pricing costs into your actual core products or service. Don't necessarily build those on as a surcharge. Secondly, we find that irrespective of how companies are positioned, whether the majority of their production is in one area or the other area, and what their footprints looks like, over the long term, companies go ahead and the pricing gaps that we saw before the tariffs were enacted versus after the tariffs were enacted remain largely the same. Now, the time to get back to those comparable gaps might differ. So again, another guideline that companies should have in mind is to maintain your competitive position. That means this is not necessarily a time due to your footprint to go ahead and increase your competitiveness. Now, you would want to go ahead, adjust, but there's nothing saying that you can't strategically deploy those investments in different ways to become more competitive in certain areas of the market. As well, I'm sure this is happening in some of your companies right now, that you're looking at how you're going to adjust your footprint, your production, your supply chain, where you're sourcing from. Now, these changes take a fair amount of time to happen. And one of the key areas as well is that we see companies are looking at new markets to expand into. The key element as we're going through some of the items today is thinking about, well, how do we make sure that these new markets are priced correctly? It's not just the financial modeling exercise where we look at the margin that we're making in our home markets, then we look at the new market, we try to see, can we do it from a cost that's margin accretive to us, and we go. The last element is, as I talk about all those changes in footprint or production, usually those elements, they come over the long term, but they drive margin improvement. We want to make sure, as we've made these pricing adjustments out there in the market, and as we're adjusting our cost footprint, we don't necessarily give those improvements back to the market, but we redeploy those cost savings to drive more value to our customers or enhance our financials. Now, these are kind of 4 high-level guidelines around tariffs, but how do we bake this back a little? And let's bring it back to what you guys are probably dealing with right now. Simple company, we sell ABCD or service ABCD. This is what they represent from our portfolio. Here is the tariff cost impact that we're going to get across those products. So product A is about 40% of our portfolio. A tariff cost is going to cost us about 5%. It's going to impact us about $3.6 million. As we look at that, overall, we can say, hey, we know we're getting an overall tariff cost impact of 5% on our portfolio. We're going to increase our prices by 5%. Our volumes adjust, differentiated based on the product that we have out there. It's about a $3.2 million impact. If we had just eaten it, it would be about $3.6 million. As well, strategy number 2, hey, we have this differentiated cost impact. Why don't we take that across our products? So we take 5% on product A, 3% on product B. We look at that, and it's about $1.5 million impact in terms of total margin. Now, obviously, negative 3.6, negative 3.2, negative 1.5, there has to be a third option. So given this volatility that we're seeing and these structural impacts that we're seeing, how should we start to think about this? How can we do this in a smarter way? What we want to focus on is really 3 things as we move forward. And this is kind of the 3 elements within that volatility that we think are going to really separate the companies that are just kind of passing it on or doing the peanut butter that we were showing in the prior slide, towards thinking about what are the new opportunities that are being created in the market, and how do we really competitively differentiate ourselves to better serve our customer needs and drive more margin at the same time. The first is getting smart around our customer segmentation. The second, rethinking how we price for value. We know the market has shifted. How do we go ahead and re-examine our fundamentals to make sure we're in the right spot? And the last, often underappreciated, but key for a group of companies, is thinking about our contract terms or our standard terms and conditions that we're providing out there. So we're going to go through each one of these. Now, jumping into customer segmentation. What do we typically see from customer segmentation? Well, we segment based on how large a customer is. We segment based on where they're actually geographically located. We segment based on what industry they're in, or what's their revenue contribution size to us. Now, I'm guessing if I could take a poll across the audience, about 90% of the attendees would say, this is kind of typically how we're looking at segmentation. What's the issue with this? Let's just think about it. 2 customers, customer A and customer B. Both of them are 65 plus, both Caucasian, both male, both live in the United States, both have a net worth over $1 billion. We've got Mark Cuban on one side, Bruce Springsteen on another side. Now, if we look at these customers' needs and what we are trying to sell to these customers, on one side, we've got an entrepreneur, investor, incredibly outspoken, On the other side, we've got incredibly, a creative person, singer, songwriter, introspective, humble. Now, as we go to approach these individuals with different offers, different pricing, different packages, how we communicate with them, it's going to be drastically different. So as we take this and think about it from a business perspective, what's the problem with just doing it about how I was talking about size or where they're located? It's subjective, it's arbitrary, we can't get to multidimensional insights, oversimplified, it's too static. And the problem is, it's not really linked to customers' willingness to pay at the end of the day. So how do we get better around this? Or how do we rethink this in the nature of our shifting environment that we're dealing with? Let's take an organization that we were dealing with. So we had a vinyl window manufacturer, relatively large company. Their segmentation was based on the channel. So they sold to large retailers, they had distributors out there, they had residential work that was going on, and then contractors that would actually do replacements. Their goal was really, hey, we've got win rates right now on the bids that are coming in around 27%. We want to improve that, and our gross profit margins are extremely low. They're actually deteriorating. How do we start thinking about that in a new and different way? Now, the challenges that they were facing and where they were trying to drive these metrics is, one, we're giving special pricing to all customers. Now, we know all customers aren't created equal. How do we start to think about this in a different way? They had a ton of guardrails that were out there. They weren't really being enforced. And as we were accelerating discounts, it wasn't leading to any volume growth. So where do we go from here? Current state of the nation, we talked about those 4 channels: retail, distributors, residential, and contractors. We're showing here what the average discount was actually provided in each channel. Now you can see the average discount, it's not drastically different. Contractors were receiving 28%, an average of 34%, but we didn't have a lot of differences in terms of the average discount that was being put out there. The win rates, there is some dispersion out there, but at the end of the day, you can see that everyone was pretty much getting a flat discount across all the channels. So where did we go? What did we look at? Well, we went through more of a data-driven segmentation. And what we found was transitioning from these 4 channels and looking at the actual data. And when we say looking at the data, we looked at how customers actually purchase. So we started to look at things like, over here we have customer count and sales share. We started to look at things like, how long was the customer with us? How much did we win with that customer? Or what kind of level did we win with that customer in terms of profitability? What was the size of the bids? What was the average price that we were putting out there? What was the product mix that we were giving to that customer? Now, this is very simplified. There was a lot of other key elements that were involved here. But what naturally came to fruition, and again, I'm simplifying, I'm only showing kind of 4 segments here, was we saw that there was kind of a grouping of customers who we call high-value relationship customers. And when I talk about high-value relationship customers, they're people who are with us for a fair amount of time. We won at extremely high levels with them. These relationship customers, they were relatively smaller in terms of opportunity size, but they were buying a superior brand mix that was in there. Likewise, we had another group of relationship customers that were very high in terms of relationship bid size amounts. We're bidding a very mixed bag of products to them, lower win rates, but we knew we had a much higher tenure. And then we had much more transactional customers. Now, what was key about this was that visualization is that they knew it was drastically different in terms of how we should come at customers. It's not necessarily based on channel. So where do we take this as an organization? We looked at, so just pulling at these high value relationship customers, I'm just migrating what I showed you on the last slide on how we define them, what their gross profit was and what their win rates were. Now, we found that these customers were, they could buy across 3 categories. One are economy windows, our base windows, and our superior. windows at the end of the day. As you can see, our margin improved based on what windows we were actually selling to them. And we looked at how many quotes we were actually going ahead and providing within each of these windows to this group. Now, what came evident very quickly when we started grouping our customers in this way is one, that we saw that when we were actually providing these customers our superior brand, we were winning much more. And we were making much more money with these clients as well. So first, we catered our messaging to these customers. We started ensuring that we showed them the trade-offs between purchasing between our economy, base, and superior lines to start enabling our upselling of those products. Next, we really started to outline the value messaging between each of those product lines and showing them the actual financial benefit on total cost of ownership, the actual warranty cost, the servicing, the customer service standards behind that. And what that naturally drove was customers upsizing into those superior windows. Next, knowing that we won so high with these customers, before we saw on our bids, we were providing a wide range of discounts based on the bid sizes to those customers. We were able to tighten that up, and no longer right off the bat were we giving these customers pretty aggressive discounts. We tightened up those discount guardrails, and we were able to, even with tightening up those discount guardrails, maintain those win rates and drive a whole lot more profitability because we knew this segment much better. We knew what they valued. So the first element is really thinking about how can we get our customer segmentation tighter to make sure our offers and our pricing are really catered to their needs. Now, you might be thinking that you had done this before, but the market is continually shifting. And with what we're seeing from tariffs and cost inputs now, it's a much different ballgame. Second, let's think about value. So you'll remember the three things that I told you. We talked about one, what's going on with competitors, what's going on with our customers and our value, and that's usually where companies really struggle. So as we think about this new environment that we're going into, let's talk about value. Now, how's a price set? Usually we start with our costs, we bake on our profit margin, and then good companies put on some discounts in there, and then we arrive at this kind of ... price. What's the problem about this? Well, our value could be up here, right? This green line over above, or even worse, our value could be down here. Either way, we need to figure out where this green line is. Now, where this green line is and the needs around the customer, it moves over time, especially in the environment we're in. So how do we start thinking about how we calculate this green line? Well, there's a lot of things that go into that green line. What I'm showing here is the B2B value hierarchy. And I'll start at the bottom. This is really how you create value for your customer. Now, what we call table stakes are things like, hey, you meet their spec, you have an acceptable price, you're not using any child labor, you have regulatory compliance. As we move up, and why this is called the B2B value hierarchy, we move up to these functional values. And here we start thinking about, well, how do we improve our customers' top line? How do we take cost out of their system? How do we improve their quality? And then we start to move up into even higher level needs. Now, what's kind of critical as you look at this is one, hey, Abby, there's a lot of stuff on this page. Yes, there's a lot of stuff on this page, but that green line, there's a lot of things that go into them. And it's imperative that we know for which customer segment we're talking about, what's important to them, how do we quantify these things, and then how do we make sure that we set our offers and our price at the right spot to go ahead and command the value that we're providing to them. So let's bake that back a little. Now, really quickly, before I transition, one of the things to keep in mind on this B2B value hierarchy, you might say, hey, why do we call this a hierarchy? And it's obviously based on this Maslow's hierarchy of needs. But as we move up this hierarchy of needs, what you will typically find is you will be getting more senior within the organization as you're dealing with this. So when you're dealing with the table stakes, it's more procurement. As you deal with more functional values, you're starting to deal with more operators. When you're moving up into purpose, we're starting to deal with more of the C-level. Now, how do we start to, great, Avy, you've given me all these kind of high-level things. How do we get down to more brass tack idiosyncrasies? So we've got a company here. It's an industrial door provider, about still relatively large organization. They got 3 core product offerings. They do installs, they do service repairs, and they do planned maintenance. When we say industrial door provider, I want you to think about a warehouse, and at the back of the warehouse where the trucks come to pick up things, it's kind of that door that comes up and down, making sure that those doors, they do the installs and the repairs to that. So really what they were dealing with, they were unsure of their price positioning, and they had not a lot of competitive intelligence. So what was the impact of that? Well, one, they were really struggling with, their sales team felt they were totally out of price position. And as they were going out there, they were losing a lot of bids, or, correspondingly, they were winning some in areas, and they weren't necessarily sure were they leaving pricing on the table. So where do we go to? How do we start to look into that? First off, and this was more of a perceived value purchase. So when customers were buying, in a lot of cases, they weren't necessary. There's 2 areas to look at this. They can do it from a financial perspective. We're going to show you a perceived perspective, and the leverage point software that Bob will talk to a little bit as well. It's over a financial perspective, but just to give you a look here, first thing we did, we looked at, for each segment of customer, and we pulled up a certain segment of customer here, what's the price important when they're making a purchase decision? How important is price versus how important is value? And this can be determined in a number of ways. We've got some sources up here. Secondly, as we think about that B2B of value hierarchy, what were the key things that actually differentiated us from the competition, but was important from the customer's eyes? So here was brand reputation, quote time, product quality. We also knew how important each of these elements were, and we were able to go ahead and score how we performed versus our relevant competitors. Again, this can be driven out of interviews, surveys, data analysis to populate this. And what we were able to do at the end of the day was put together some value maps. And what we're looking at just quickly is, along the vertical axis is relative price. The higher you sit on this map, the higher price you have. Along the horizontal axis is relative value. The further to the right you sit, the more value you're providing. This green upward sloping line is the fair value line. This is the rate at which a customer trades off between price and value. The left, anything to the left of this line is value disadvantage. You're offering something to the customer for a higher price than they would expect to pay for the value you're providing. Anything to the right of the line is value advantaged. So we were able to plot all of the competitors and the client, and very quickly, I know this is one customer segment, one product, we were able to quickly identify areas of opportunity to price within the portfolio, and correspondingly areas where we were mispriced in the portfolio. Now, the key thing to take away from this is, as you're thinking about, upfront, I showed you those tariffs, and we had kind of these differentiated tariffs and how they affect our products or services, and we can kind of get out of the peanut butter and the peanut butter knife and start to spread it around. What something like this helps you do, you get much more targeted on thinking about what products or services do we actually have pricing leverage within the market? What customer segments do we have leverage within the market? And we are doing this from a customer standpoint and also a competitive standpoint, because we know our customers' value positioning of us and where our competitors are moving, given the cost impacts that they're seeing or the adjustments they're making in the market, is all shifting. So it's really critical that organizations go ahead and they redo this work and push into it in a very aggressive way. Now, this is something that, given the change in the market, even though you might have done it 2 years ago or you're doing it on an annual basis, you really wanted to take the diligence and make sure your company goes back through it. What was the impact on this organization? Well, they went through the entire product portfolio and there was a lot of adjustments made in terms of ups and downs, and they actually improved gross profits whilst holding win rates relatively flat. So it was a pretty significant adjustment, but what was even more critical was with this strategic clarity, the sales team was really able to understand, based on the class of customer that we were going into, here's what we should be selling them, and here's why I am very confident in our price position, and here's how we can go ahead and explain that to our customers. So for example, for this customer, we'd be making sure that we're punching out our quote faster than the competition, and then we would be emphasizing what all the attributes behind our brand and our product quality, and making sure the customer understands that and the trade-offs between us and the competition, so they can understand why we're price positioned, where we're price positioned. Okay, last element for today, contract terms. So as we think about contract terms, I don't only want you to think about contract terms in terms of long-term pricing agreements. These could be going ahead and actual programs that you're giving to your customer for a term basis, or any structured terms and conditions that you go ahead and provide to your customer, or anything around your rebate programs or any discounting programs or production or service creation programs. So let's have it more kind of all-encompassing that. Now, what do we see around contract terms and pricing, and also thinking about this dynamic environment? Well, in a lot of cases, companies are being forced to rethink their contract terms, and why? Well, as we find that oftentimes there's no differentiation in contract terms across customers. Oftentimes where there's kind of one-on-one negotiations with sales teams and contracts, that there's discretionary terms or adjustments that we gave to customers that aren't necessarily consistent. So there's a lot of complexity out there, or there's stuff that catches us by surprise. As we roll over contracts, it's often easy to just take what we had before, sign again, and move on again, or we've got no terms around pricing. We're very limited terms that we've got these black swan events that are affecting us very quickly, and we just don't, we can't take price for 160 days, or we've provided long-term price agreements to a customer that we can't even adjust it, and we find ourselves being in upside down positions to this customer. So, this is kind of the worst case scenario, that we're seeing the new cost environment that we're in, and we're getting hamstrung with, hey, 40% of the business is contracted and we can't adjust that pricing. Well, we've got industrial metal components manufacturer, and what they were specialized in, they made very specialized components that would go into production lines. And what you want to think about this as is like, it would be a component that would be, let's say we're manufacturing iPhones, it would be on a certain machine on that line. It would run for about 10 years, had to be highly spec'd, and you're expecting this in as you're thinking about building this line up. So you're kind of doing this 3 years before the fact. Now, what made this pretty complicated was that you're thinking about how you're going to manufacture this component in advance. You're not even manufacturing it. You need to think about all those costs in advance, but your customer is looking for a long-term pricing agreement, because they're going to be looking to buy this over the next 10 years. They're not going to start buying it for 2.5 years, and it's not necessarily fully spec'd yet. Now, what was the problem? Well, the organization, as this kind of dynamic environment was hitting them, they were being hit with a lot of costs that they weren't expecting. They had set fixed pricing, So they were upside down in a lot of areas. They so a couple of key challenges. One, as they're setting these contracts up front, they would go and have an anticipated lifetime, but the profitability would deteriorate over the duration. We didn't necessarily, as we were setting these contracts, have the right cost forecasts due to lack of clarity on those costs. So even what we would expect from the forecast wasn't achieved on our outset of that. We had no guaranteed volume from customers because they don't know what's necessarily going to happen in 3 years. And we had terms around customer share of wallet on how much they should be buying from us, but we were not necessarily enforcing that. So where do we go from here? You know, it's kind of the perfect storm. We've got these contracts that are in place, they're deteriorating in value. We've got these contracts that we're putting out there. We don't necessarily know what's happening. Well, I'm going to kind of go back to where we were before. And what we say is good pricing really centers around good customer segmentation. I know we talked about that up front, but if we can figure out what customers we're actually selling to and what their needs are, we can start to think about, well, how do we structure everything around it? And we were talking about, you know, value pricing up front. How do we start to think about that from a contracted perspective as well? So what we've got kind of a 2x2 here. We got price sensitivity on the vertical axis. We've got the degree of product specialization along the horizontal axis. And we started to group our customers off. So in the top left here, we had very high price sensitive customers, very low product specialization. And we looked at how many contracts we had in there and how much revenue was sitting there, but we looked at what's the key value driver for this customer. Well, they're incredibly transactional in nature. They kind of come in and out of us. The price is the key driver because they can move this to any competitor relatively quickly. No, then we moved down a little bit more and we saw that they had a bit more product specialization that was required. We had these strategic buyers. And what was important to them? Well, we looked at how much they engaged with the customer support. They wanted us to, we had tight timelines that we had to respond to them. They wanted us to carry enough inventory for them so we could support their production. And they had fines in there if ever we weren't able to supply them. We had looked at people like, for example, our convenience buyers. We didn't have a lot of product specialization around them, but they weren't very price sensitive. And why did we see they weren't very price sensitive? They were buying everything from us. They just looked at, we had very good relationships from them. We were actually helping them on consulting on how they should be setting up their production systems and whatnot. Now, as you can see, we're kind of defining each group of customer and we're understanding their needs at a very granular level. So, and we're understanding how many contracts we have sit under each one. So what do we do with this? Where do we go? Well, we start to think about, as we are looking at each of those groups of customers and these long-term pricing agreements that we are being asked to give to these customers, what are the actual guideline terms and conditions that we should put in place? So that group number one, as I talk about those price shoppers, well, they no longer qualify for a long-term pricing agreement. It locks up capacity for us and it's low value volume. If the customer is demanding that they have to have a long-term pricing agreement, now we provide pricing to them based on them meeting certain volume thresholds. As they hit certain volume thresholds, their price will go down. Or if they are unable to hit those pricing thresholds, they go ahead and get incremental costs. They've got, we show them that here we've got actual pricing escalators within the contracts over time for a fixed pricing that we're going to drive. And we show them that it's to mitigate risk around some of those lower prices. As well, all of those value benefits that I was talking about on that previous page, like having certain production quality, carrying inventory, providing access to our customer service. We had costs associated with each one of those. as we think of our customers who are innovators, now think of innovator customers who are customers who are looking to, for example, bring a new drug to market. They are going to kind of disrupt the market. They want to get it out there in 4 years, and speed is going to be key to them. Really, the technology and what they're bringing out and the value of what they're bringing out is key to them. You know, one, we want to avoid long-term pricing agreements with these customers. They don't typically even know what kind of volume they're going to drive. And we want to price these things relatively high because they're relying on a lot of our back-end value drivers. Now, if a long-term agreement's needed, there's a proper price premium associated with that. There has to be volume commitments associated, and they've got upfront charges for our capital development. There's a fee for revising anything around what we're producing for them. And we also want to match our long-term agreement, pricing agreement, with the duration of that product life cycle. So now what's kind of critical as we're kind of talking to these, you know, we can go through more of these kind of groupings. It's really around making sure that our pricing and how we're structuring these offers and the value elements that we're speaking to, it's coming across in our contracted terms. And it makes it very clear to the customer, if they're trading off price, here are the benefits that are associated for them, and we're making them make real trade-offs that actually matters to them. And why we know they matter to these buyers is because we properly segmented them with them. So as we kind of went through this journey with this specialized producer, we saw it improve customer retention by 7.1%. It actually improved the annual price. We started to realize an annual price increase of 4.1%. And since we started introducing some volume thresholds to it, it drastically increased our customer engagement and the nature of the discussions that we were having with our customers, because we're building that into the contracts. Now, I know I ran through a lot of material relatively quickly, but before we jump into key takeaways, I know, Bob, you had some elements you wanted to share with the team.
Yeah, no, thank you, Avy. That was very, very informative. I appreciate it very much. And I'm sure our audience does too. I'd like to just tell people about our upcoming webinar and first say a brief message about Leverage Point. For those of you who aren't familiar with Leverage Point, we are a B2B SaaS platform that enables companies to translate the features and benefits of their products or services into economic value propositions or financial value propositions. To date, we have facilitated more than $2 billion in revenues for our customers, and we can do the same for you. But enough about us. So the next webinar in our series is going to be how to get started with value selling. You understand that in today's B2B landscape, selling on features and price just really doesn't cut it, and top performing sales teams are turning to value selling. And it's really a strategy that clearly articulates the economic impact of your solution to each buyer. So in the upcoming session, you'll learn things like how to jumpstart your value selling initiative using AI-powered tools. What are the foundational steps to build your first value proposition? And we'll also go through some real-world examples of companies driving ROI with value selling. We'll have some great guest speakers with us as well. So with that said, thank you very much for attending. I'm going to turn it back over to you, Avy, to go through the key takeaways, and we'll answer questions that have been submitted during the session. Thank you.
Perfect. So as we think about tariffs and volatility and your tasks within your organization, first thing, any decisions you're making, make sure that you have a view on what's happening with your customers in terms of value. Make sure you have a view of what's going on in the competitive market. Make sure you have a view of your financials. And overlay to that, what we want organizations to really focus on is, one, relook at your customer segmentation. Take a deeper look. What are the actual groups and needs that you have there? This market that is shifting, we see customers on how what they've got for budgets out there and how they're trading off between different competitors. It's shifting. It's going to necessitate a change in your pricing and how you're packaging your offers, and it's going to provide opportunities to you. So don't just peanut butter, really get an understanding of that's what's going on with the segmentation. Next, price for value. So, Bob was talking about financial value there, thinking of perceived value. However you're calculating that value, updated. The market has shifted, updated where across the portfolio at a very granular level, by product, by service, by customer segment. Where are we currently positioned versus the competition? Where are our opportunities? And you can get very targeted in terms of the adjustments that you're going to make in the market to make sure that you're properly positioned. And last but not least, because this is often overlooked, look at your contract terms. There's often a lot of money that is sitting out here, and it's hard going back in and talking to customers about price increases on an annual basis. The more that you're able to structure into your contracts with terms that provide you the proper level of monetization, it's going to make it much easier, especially if you're centering it around customer needs. So those are the three things that we hope you go back and challenge your organization with today. With that, I'm going to leave it open for any questions that came up during the session. Be happy to take kind of the last 14 minutes that we have and really deep dive into that.
Okay, Avi, we do have a few questions here. And if you have them, again, please submit them into the question feature. The first question is, how do you suggest that companies communicate to customers on tariff pricing changes?
Yeah, that's a great question. I think there's three things. Anytime you're communicating on pricing changes, there's always needs to be kind of three main aspects to it. One is your customer is going to be looking for, hey, is this fair or not? And when we talk about fair, obviously we're making it clear that why we're talking to them today, there's cost implications. We've experienced cost implications. And what's great about tariffs is it's not too hard to argue that one. Like there's not too much pushback that can be given. The second piece is on that fairness is that this is affecting everyone. What we're doing here is market-wide. The second component around what needs to be in that pricing communication is, customers are going to go ahead and push back and say, why don't I go down the street and buy it from someone else? This is where you need to communicate your value. And here's why it still makes sense to do business with us over the other competitive alternatives that you shop, and making sure that we make that clear and we're ready to talk about that. And the last element is around, what customers can as well push back on is, okay, I understand what you're doing, but can we get this delayed for another 180 days? Can I go ahead and front end buy? Can you hold it on these products? Can you cancel it out if we go ahead and start stocking these other products with you, or we prioritize you in this way? Now, what all that is negotiation. And you want to make sure that your sales teams have clear guidelines on what they're able to negotiate on and what they aren't able to negotiate on, and kind of here's where the lines are so we can maintain consistency. And the last thing I'd say is, especially with tariffs and the volatility we're seeing, some customers are going to ask for cost transparency. And they're going to say, okay, what's going up, at what rate, and what percentage of your product or service is that impacting? Now, there's nothing wrong with providing, commodity indexes that are widely market available, but we often say you never want to go down to the discussion where you're disclosing proprietary information and showing them that level of detail, because when we say proprietary, hey, here's what my footprint looks like, here's what the granular cost elements are, here's what that looks like at a SKU level, because you're stripping all the value away, and you're going to get into a discussion later on of, hey, as these things adjust, our pricing should float in a likewise manner. You want to also be able to be clear on what you will provide to your customers and what you won't provide to your customers.
Okay, thanks, Avi. Okay, the next question is, what should I do if my competitors have openly stated to customers that they are not pricing for tariffs?
That's a great question. We get that a lot when we go into companies, especially now. Where we move towards is, though, usually organizations are selling a wide portfolio of offers to customers. They're selling across a wide group of customers. They're selling across a wide region. If we truly find that a certain competitor out there is not pricing, I mean, pricing, it's not a sport where you're going to find your money is you want to get laser-like focused. So you want to start to look at, well, is this happening right across the portfolio? Is it happening in each of my classes of customers? Is it happening in right across all of the regions? And you want to look at areas that they are much more competitive versus us, that we have no value differentiation, that we do have to go ahead and invest, or where are areas that we know we can increase that pricing differential and we're okay because we've got the value to support it. Now, the worst thing an organization can do is just take that feedback and take it kind of carte blanche. Where all the value is going to be created is getting to that deeper level of granularity, and then ensuring that the team is properly enabled with those key insights and those tactical insights to go after it at a customer, segment, product level, and really being rightful focused.
Mm-hmm. Okay, great. We have two more questions in the queue here. The next one is, what are some of the biggest mistakes you have seen companies make in dealing with market volatility or tariff-related pricing?
Yeah, so I'll first kind of talk about it internally, and I'm sure a lot of people on this webinar have dealt with it. I'd say kind of for the past, 7 to 9 months, we've found that an inordinate amount of internal resources have been devoted to just scenario running within organizations. If tariffs are at certain levels, here's what the cost impact is going to be on us. If we move supply in various areas, here's what the cost impact is going to be. It's a lot of what if. And I think that it's been devoid. It's been a ton of financial modeling, which it's important. But what it's been devoid of is what's going on with the competitors out there, what's going on with the customers out there. And that's kind of the first real kind of watch out that we're kind of gauging companies on. The second, when we talked about that up front, that's externally. We've seen a lot of companies that they get the cost increases, they send out the spreadsheets to the sales team kind of overlays, but at the end of the day, we're just kind of peanut butter. When we peanut butter, we've seen it kind of time and time again. We were dealing with an actual construction building manufacturer equipment, and they had kind of peanut buttered it out there, and they took 3 years to go ahead and regain the market share that they had out there and really just because they are not looking at this strategically whatsoever. So I think that's the other big thing. This isn't a financial modeling exercise. You really want to ensure that you're taking a strategic price increase out to the market. Don't just let how your footprints or how tariffs or how inflation is impacting you dictate what you're going to do from a pricing perspective.
Okay, another one here. What about for services? Services are not typically subject to tariffs like goods, but can have an indirect effect. Thoughts on how to handle? Question mark?
Yeah, that's a great one because we often get that about software too. I'm in the software industry. My costs aren't impacted like that. I'm not going to be subject to any of these levies. Now, what I think is much more important for these types of companies is thinking about your customers. And what we found with a lot of businesses out there, a lot of them are putting in place different spending limits or freezing budgets. They're thinking about where they're going to be having to make investments. They're looking and planning in different ways and what they're going to need before certain expenditures can be made or adjustments. So with that, it's thinking about these companies that are actually going to be impacted and how are they changing their decision making or their operations based on, they might have different, they might be changing in terms of their price sensitivity, they might be changing in terms of their budget needs, they might be changing in terms of the services that they require from us. Is there anything that we can do to tailor our offer, to their new pricing needs, or to tailor to what they're going to need from a service perspective, so that we can better meet those needs and realize incremental, not only customer engagement and loyalty from them, but bring a product or service to them that we can drive and fit what their budget out-of-pocket needs are and their price sensitivity needs. And this is going to really help us differentiate ourselves versus the competition. So I think the key kind of tangible thing to that is saying, if you're unaffected by tariffs, you want to look at your customer, because I'm sure some segment of customers is going to be affected by it, and what opportunities can this unlock for you?
Okay, thank you. Okay, we have time just for one more question here quickly. Last question is, how can teams build internal alignment to execute pricing changes successfully?
Yeah, I think we always say pricing is a team sport. And as we're, that revenue equation with the price times volume, I mean, revenue, it impacts everyone: finance, sales, marketing, the executive team. And we actually ran a survey in 2025 and 2024, and we looked at organizations that outperformed from a pricing perspective versus organizations that underperformed. And when we say outperform versus underperform, we looked at where they were actually setting their pricing targets and what the degree of achievement was, and also their rate at which they were growing revenue. And organizations that did better were actually cross-functionally engaging with pricing. So that means that they had sales, finance, marketing, product involved within the pricing, actual pricing function, and coming to those decisions. And what was one of the key elements was they had the C-level executives that were involved. And those organizations statistically materially outperformed organizations that were more doing it in a siloed function. So I think what's key in terms of building that alignment is getting each of those stakeholder groups involved. And what that forces is, as we talk about those three pillars, looking at the customer, looking at the competition, making sure those financial aspects are taken into account, you get a much better view of how you should be executing strategically out there in the market.
Okay, well, thank you very much, Avy. Thank you for participating, everyone. Our time has ended, and we look to see you again at our next session. If you'd like, I threw my calendar in the chat. If you'd like to talk with me or anyone on this team, you can send me a note and I'll facilitate it. Thank you very much, everyone. Have a great day.
Thank you.